Hello everyone, welcome back to Gold Rush Reporter. Before we dive in, please hit the like button and subscribe if you haven't already. It helps this community of silver and gold stackers grow and stay informed. Today, we're diving into a question many of you have been asking. Silver versus gold. What's the better long-term hold after 2025? 2025 was a year unlike any other. Silver outperformed gold by a huge margin, and that has forced a lot of people to reconsider their long-term strategy. Gold rose about 67%, which is incredible on its own. But silver? Silver surged roughly 150%, more than doubling gold's gain. For stackers and investors, that's a huge shift and something that can't be ignored. Now, let's break this down. Gold behaved largely as expected. It rose steadily, preserved wealth, and rewarded patient holders. Silver, on the other hand, was a roller coaster. We saw intraday swings of 10% at times. Holding silver requires psychological resilience. If your portfolio is sensitive to volatility, silver can be anxiety-inducing. That's a key consideration when comparing it to gold for long-term holding. Personally, I've had mixed experiences with silver in the past. Some years it was rewarding, other years it was painful. But the silver I picked up in late 2024 was meant for a specific strategy: flip to gold at a target price. The idea was to capitalize on short-term gains while maintaining gold as a stable, long-term asset. Fast forward to 2025, and silver didn't just perform, it blew past expectations, making it impossible to ignore. When evaluating long-term holding potential, there are a few key factors to consider: performance, volatility, and premiums. Performance is obvious. Silver clearly outperformed gold in 2025. But volatility is where silver challenges stackers. Massive daily swings can lead to emotional decision-making, which can compromise long-term gains. Gold, in contrast, is much steadier, making it easier to hold without second-guessing. Premia also play a role. Depending on when you purchased, silver often carries higher premiums than gold. In 2011, if you were accumulating silver at the top, your costs were significantly higher than gold. In 2020 and 2024, silver was cheaper in terms of spot price, making accumulation easier. Timing has always been a critical factor for silver. Let's talk about historical context. From the 2011 tops, silver fell roughly 73% and took 14 years to reach a new all-time high. Gold, by comparison, fell about 45% and recovered in 9 years. This illustrates a major point. Silver can be dramatically more volatile over long periods, which is an important consideration for anyone using metals as a long-term store of value. Despite that, the recent surge puts silver back on par with gold in terms of returns since 2020. For some stackers, that may validate a second look at silver as part of a long-term strategy. But it comes with a mental cost. Holding silver is not for everyone, especially if you prefer stability over rapid swings. For me personally, my allocation currently sits at roughly 80% gold, 20% silver. That's because I still view gold as a rock-solid, long-term store of wealth, while silver carries both higher risk and higher reward potential. That ratio could shift depending on future price action, but it reflects the balance between stability and opportunity. In this video series, we're going to break down silver's volatility, potential, and strategic role as a long-term hold. We'll look at historical performance, psychological factors, and practical allocation strategies. By the end, you should have a clearer idea of whether silver deserves more weight in your portfolio, or whether gold remains the undisputed long-term champion. Now that we've set the stage with 2025's silver and gold performance, let's dig deeper into the volatility and price swings that define silver's nature. While gold moved steadily, silver's price action was extreme. It's what makes silver both exciting and stressful for stackers and investors. Understanding these swings is essential for long-term planning. In 2025, silver regularly experienced 10% daily swings. That's huge when compared to gold, which might move a fraction of a percent on the same day. These swings weren't random. They were often triggered by market mechanics like CME margin changes, speculative trading, or short-term repositioning. For example, when the CME raised margin requirements in late 2025, gold fell barely 0.1%, while silver dropped 5.6% in one day. That's not because demand disappeared, but because leveraged positions were being adjusted. Psychologically, this level of volatility can be a double-edged sword. On one hand, silver can reward attention and patience, offering opportunities to profit if you know your targets. On the other, it can lead to regret, second-guessing, or even panic selling. If you're stacking silver as part of a long-term strategy, you need mental resilience. You must be prepared for swings that make gold holders yawn. This is why timing has always been critical for silver. My own experience illustrates this well. I picked up physical silver in September and October of 2024, and also increased ETF holdings. My original exit target was $75 an ounce, then later $80. But after seeing what 2025 delivered, I questioned whether selling at all made sense. The lesson here: silver can surprise, and flexibility is key. Scale is another practical consideration. Silver is much lighter in value than gold. For example, $100,000 in gold is roughly 23 ounces, easy to store and manage. The same $100,000 in silver is about 1,400 ounces, requiring far more space, careful storage, and handling logistics. This impacts how much you can hold, how you insure it, and how you plan your long-term stack. Many stackers overlook this until they face the reality of managing large volumes. When analyzing long-term holding, there are three main factors to weigh. First is performance. Silver clearly outperformed gold over 2025. Second is volatility. The wild swings demand discipline. Third is premiums. Depending on when you acquired your metals, the cost basis can affect overall returns. For example, early 2011 buyers faced high premiums on silver compared to gold, while 2020 or 2024 acquisitions were cheaper for silver. Understanding these dynamics helps you evaluate whether silver fits your long-term goals. There's also the emotional side. Holding silver over 14 years, as we saw from 2011, meant enduring large losses and long recovery periods. Gold's journey was steadier and required less constant attention. But silver's explosive recent gains demonstrate that patience can pay off massively, even if the ride is rough. For those willing to handle volatility, silver offers a potential reward multiple times higher than gold. Finally, consider allocation strategy. An 80-20 split between gold and silver reflects a conservative approach, prioritizing gold's stability while still participating in silver's upside. A 50-50 split would reflect equal conviction, but comes with far higher volatility exposure. Your personal risk tolerance, mental resilience, and storage capacity should dictate the balance. Continuing our deep dive, let's now explore the historical performance of gold and silver and how it shapes your long-term strategy. Understanding the past helps us make smarter decisions for the future, especially when it comes to holding metals over years or even decades. From the 2011 peaks, silver experienced a brutal decline of about 73%, taking 14 years to regain that all-time high. Gold, by contrast, fell around 45% and recovered in roughly 9 years. This stark difference highlights a major point. Silver is inherently more volatile over the long term. Holding silver requires patience, conviction, and tolerance for dramatic swings, while gold tends to offer a smoother, less stressful journey. For long-term holders, these historical cycles are critical. Silver's long nap after 2011 meant that anyone who exited early locked in either realized losses or opportunity costs. Meanwhile, those who remained patient ultimately benefited from the 2025 surge. This demonstrates a key lesson. Silver can outperform massively, but only if you can endure its wild ride. Now, let's examine the performance comparison from another angle. Since 2020, silver has risen roughly 4x, while gold has increased closer to 3x. Both metals have delivered outstanding returns, but the volatility of silver has been far higher. This creates a trade-off between potential gains and psychological comfort. Investors must ask themselves, can I tolerate the swings? Can I sleep at night while my portfolio moves 10% in a single day? Premiums and cost basis also matter. In some periods, silver carried higher premiums than gold, making accumulation more expensive. In other periods, like 2020 and 2024, silver's spot price was lower, giving an advantage to stackers who bought aggressively. Timing your purchases, especially with silver, is crucial. Accumulate too high, and your returns are diminished. Accumulate strategically, and you may capture the explosive upside we saw in 2025. Another factor is scale and logistics. A $100,000 allocation in gold is roughly 23 ounces, easy to store, secure, and manage. The same $100,000 in silver is about 1,400 ounces, or roughly 35 times the volume. Storage, insurance, and transport logistics become a serious consideration for long-term holders. Many underestimate this until they actually handle large quantities of silver, making gold more practical for wealth preservation. Silver also demands active attention. Because of its volatility, long-term holders often need to monitor markets more closely. Gold, by contrast, allows for a set it and forget it approach. This difference explains why I currently hold an 80-20 split, favoring gold for stability while maintaining exposure to silver for upside potential. A more aggressive investor might opt for a 50-50 split, but that comes with a higher risk profile. So, when deciding between gold and silver as a long-term hold, 3 key questions must be asked. Performance. Which metal has historically delivered better returns over the holding period? Volatility tolerance. Can you handle swings that may temporarily erase large portions of your portfolio? Practical considerations. Do you have the capacity to store and insure larger volumes of silver? The answer isn't simple. Silver can offer tremendous upside, as we saw in 2025, but it comes at the cost of higher volatility and management challenges. Gold is steadier, predictable, and psychologically easier to hold. Ultimately, it comes down to your personal risk tolerance, goals, and investment horizon. Now that we've covered silver's history and volatility, let's focus on practical strategies for long-term allocation and how to balance gold and silver in your stack. This is where theory meets reality. How do you actually manage these metals over time, considering both financial and psychological factors? First, let's talk about allocation ratios. Many long-term holders favor a higher percentage of gold for stability and lower volatility. That's why my current split is roughly 80% gold, 20% silver. Gold serves as the backbone of the stack, protecting wealth and acting as a store of value. Silver, on the other hand, functions as both a growth asset and a tactical trade. Its volatility allows for potential higher returns, but it also requires active monitoring. If you have a higher risk tolerance and a willingness to endure price swings, you might consider 50-50 gold and silver. This approach maximizes potential upside from silver's explosive moves, like those seen in 2025. But it also amplifies psychological stress during downturns. Understanding your comfort level with these swings is critical, because if you panic during a dip and sell, you defeat the purpose of long-term holding. Next, consider timing and cost basis. In my experience, accumulating silver during lower price periods, or even during dips in volatility, can improve long-term returns. For example, my physical silver purchases in 2024, around $30 an ounce, positioned me well for the 2025 surge. Had I bought at higher points, the risk of drawdowns would have been more severe. Gold, being more stable, allows for accumulation over time without worrying about timing as much. This highlights a key principle. Silver demands strategic accumulation, whereas gold allows for a more straightforward buy and hold approach. Storage and logistics also play a major role in allocation decisions. Physical silver occupies significantly more space than gold. A $100,000 allocation translates to 1,400 ounces of silver versus 23 ounces of gold. This difference impacts not only storage costs, but also insurance and security measures. Long-term holders need to plan for these practical realities. Otherwise, the challenge of managing large volumes may undermine your strategy. Gold's higher density and lower volume make it easier to store, making it ideal for core wealth preservation. Another consideration is trading versus holding. Silver is highly responsive to market events, margin changes, and speculative positioning. This makes it suitable for tactical trading and capitalizing on short-term gains. Gold's steadiness, however, makes it better suited for sleep-at-night investing. For many investors, the optimal strategy is using silver as a growth lever while gold provides stability. This balance allows you to benefit from silver's upside without overexposing yourself to its volatility. Psychological factors cannot be overstated. Silver's wild swings require discipline and emotional resilience. You must be able to ignore short-term noise and focus on long-term trends. Gold, by contrast, offers a psychological advantage. Its steadiness encourages patience and reduces the temptation to make impulsive decisions. Finally, let's consider rebalancing and review. Over time, market moves may alter your intended allocation. Silver's rapid gains could increase its share beyond your comfort level. Periodic review allows you to rebalance your stack to maintain the intended risk-reward profile. For example, after 2025, silver's performance may tempt holders to overweight it, but doing so could amplify risk if volatility spikes again. To summarize, long-term allocation requires a balance of strategy, psychology, and logistics. Use gold as the foundation for stability. Employ silver as a growth asset or tactical tool. Consider risk tolerance, volatility, and comfort level. Account for storage, insurance, and scale. Periodically review and rebalance to maintain intended allocation. Now, let's wrap this up with final thoughts on silver versus gold as a long-term hold and actionable guidance for investors navigating the current market environment. After examining performance, volatility, cost basis, scale, and allocation, it's clear that both metals play unique roles in a portfolio. But how you use them depends entirely on your goals and risk tolerance. Gold remains the bedrock of long-term savings. Its performance may not always be dramatic, but it provides stability, predictability, and peace of mind. For most investors, gold is the set it and forget it portion of a portfolio. You don't have to monitor daily swings, and you can confidently allocate a substantial portion of your wealth to it without worrying about panic selling. Its history shows resilience during market crises, inflationary periods, and geopolitical uncertainty, making it ideal for wealth preservation. Silver, on the other hand, is a higher risk, higher reward complement. Its volatility can be daunting, as we saw in 2025 with daily swings of 10% or more, but it also allows for explosive upside. Silver's volatility rewards attention, patience, and tactical trading. If you are comfortable actively monitoring markets or positioning strategically, silver can significantly enhance portfolio returns. However, its storage and logistical considerations mean it's less practical as the core long-term hold compared to gold. The key takeaway for long-term investors is diversification within precious metals. Holding both gold and silver provides a balance between stability and growth. My current 80-20 allocation favors gold as the safe core, with silver offering upside potential. For more aggressive investors, a 50-50 split could work, but it demands psychological resilience and tolerance for market swings. Whatever ratio you choose, it should align with your risk profile, goals, and comfort with volatility. Another important factor is timing and accumulation strategy. Unlike gold, silver requires careful consideration of entry points, premiums, and market conditions. Strategic accumulation at lower prices or during periods of volatility can significantly improve long-term returns. Gold allows for a steadier, dollar-cost averaging approach, while silver rewards patience and strategic attention. Investors should plan their purchases thoughtfully, especially if silver is a substantial portion of their portfolio. Practical logistics are also crucial. Silver's bulk and volume create storage, insurance, and security challenges that gold does not. Large allocations of silver require space, safes, or professional storage solutions, while gold can be more easily managed in smaller quantities. Ignoring these practical realities can turn long-term holding into a logistical headache rather than a financial advantage. Finally, let's address psychological readiness. Silver's price swings can trigger anxiety, impatience, or impulsive selling. Gold's stability, by contrast, minimizes emotional decision-making and helps maintain discipline. For new investors, understanding your own reaction to volatility is essential before committing large amounts to silver. If you panic during swings, you risk missing out on substantial gains. In conclusion, the optimal strategy is a combination: gold for the core, long-term, stable wealth preservation; silver for tactical exposure, growth potential, and higher risk, higher reward plays; regular review and rebalancing to maintain intended allocation; strategic accumulation and timing for silver to enhance returns; awareness of storage, logistics, and premiums to avoid unexpected costs. The 2025 performance has certainly reshaped perceptions of silver, but it does not replace gold. It complements it. Gold remains the foundation, silver the amplifier. Investors should approach silver thoughtfully, respecting its volatility while leveraging its upside potential. Ultimately, the question of which is better as a long-term hold depends entirely on your risk tolerance, goals, and capacity to manage volatility and logistics. There is no one-size-fits-all answer, but understanding the trade-offs allows you to make informed decisions and structure a portfolio that benefits from the strengths of both metals. So as you plan for the future, consider your objectives, assess your tolerance for swings, and balance gold and silver accordingly. Doing so ensures you are positioned for growth while protecting your wealth, no matter what the market throws at you.